About the Honasa Consumer IPO itself. It's a 1700 crore IPO, opens today, the price band 308 to 324 rupees per share, looking at a post-listing market cap of 10,424 crores. Now, this is a company where the revenues of the company have grown 80% CAGR over the last few years, and that's much higher than the industry growth of 28% itself. But nearly 40% of their sales go back into advertising, and as a result of which the EBITDA margins are in low single digits. What does the company do from here? What are the growth targets? But more importantly, is the valuation at current levels justified? And what the plans for the future are in terms of margin expansion? We do have with us Varun Alagh, who is the chairman of Honasa Consumer, better known for its products like mamaearth, joining us now. Varun, thank you for joining in, and congratulations on the opening day of your IPO. We've been having this conversation about, what is a sustainable growth trajectory for the company. 80% is what you've done. Just a week ago when we spoke, you said that settling in, you would obviously grow faster than the industry. The question is, how much faster and by when? What is the steady state growth rate for you?
Hey, Mangalam. It's a great morning. We are so happy to sort of be at this juncture where in just less than 7 years of our existence, we've been able to see this day come to life. It's genuinely the story of New India. We've, of course, been building and growing our brands at a breakneck pace, right? Because the consumers have loved the offerings that we provide to them. Right? We'll keep offering the right innovative products to our consumers, keep expanding our distribution. Right? There is a lot of opportunity in this growing BPC market that we can capture. Right? And hence the long-term growth is something that we are very, very confident about. Right? I would still say we would continue to grow significantly ahead of the industry, and that will be our objective. And of course, we will also focus on profitable growth from here on and try to make sure that we become even more efficient as we continue to grow.
Well, hi, Varun. Good morning. Nigel on this side. My co-anchor, he's been tracking the numbers, and I've watched a couple of your interviews as well. So on the numbers, I think he's on top of it. But as someone who's brought up 2 children in the last 5 years or so, I have to say the brand is doing very well, and the products are very, very good. But now we need to talk about numbers. So besides the consumer, which I was included, now you'll have to worry about analysts as well as the stock market. So let's get a couple of numbers out of the way then. You're going to outgrow the industry. In the last 3 years or so, you've been growing at around 2.5 times what the industry has grown at. Do you expect to continue that momentum? And also plenty of debate on social media and other circles as well about the valuations. If you analyze the number as well, it's close to around 100 times. What do you have to say, Varun?
Let me answer the second one first. So I think for a fast-growing company, which is in investment mode, right, like ours, right, pure P by E might not be the best ratio to use as a comparative ratio. And better ratios to use are price to revenue, price to gross margins, right? Because in the long term, that's where the flow through happens. Right? If you want to use P by E, use PEG, which is PE adjusted for growth, and drive comparisons basis that, right? Because it is relatively faster growing company and choosing to invest in driving faster growth. So I think if you will compare basis the price by revenue, price by gross margin kind of ratios, right? You would actually find that we are attractively priced, right? But from the social chatter, I think what we have learned from Geeta also is ki karm pe focus kar, comment pe mat kar, right? So we will continue to focus on showcasing.
So let's focus on the karma itself, Varun. You said that the best way to look at it would be PE by G. PE we know. Tell us about the G. I mean, that's what we're trying to figure out. What is the sustainable growth rate that you're looking at? And in that as well, when you grow, what will your margins settle at eventually? Because like you said, it's an investing company right now. As you grow, scale benefits come by, ad spends come down, all of that discussion for a bit, while we talk about that. But what is the likely growth rate that you're going to settle at? And at that level, what would your margins be?
So I think from a likely growth rate, an objective would be that, we are very bullish on the overall BPC space, right? And we believe BPC is going to grow at a 10 to 11% CAGR. And we would want to make sure that we grow, more than twice of that and continue to sort of, have that pace over 5 to 7 years. Right? Now, from a margins perspective, already as we are growing as a company, we are seeing that efficiencies are kicking in. Right? In the last 2 years, we have not just built one brand and scaled it to more than 1,000 crores, but also launched 5 more brands and invested on them. Right? And even after those investments, right, we have remained positive in terms of our margins. Right? And I think we are seeing already Q1, we are at about 6% net EBITDA compared to 1.5 last year. So as we are scaling, we are seeing leverage on marketing, leverage on OPEX sort of kicking in. Right? Of course, over time, the ambition will be to ensure that we not only continue to grow faster, but also continue to showcase better efficiencies.
All right, Varun, your ad spends as a percentage of sales are quite high, close to around 40% approximately. Where do you see that number settle? And where do you see that leverage, the leverage from these ad spends start playing out?
Sure. So if you look at, this number, what you're saying, 40% was a number for FY22. As we see it, it has gone down and already come down to a 35% now. Right? And this is, like I said, is a sum of parts, right? Because when in FY22, it was largely being spent on one brand. Right? And then moving forward, it's been spent on 6 brands. Right? And when brands are younger, this percentage is far higher for them because, a certain amount of marketing needs to be spent. We are in the business of finally brand building. Right? And you need to drive a brand awareness to actually get the brand to sell and trials to get generated, and then consumers start buying and more, right? So I think even in that brand building period where we were building 5 more brands, and we've been able to showcase that this at a company level has come down. And so, of course, for Mamaearth, it is even lower, and we're choosing to reinvest that in our younger brands, right, and driving growth for the company.
All right, we'll await the leverage to play out. The first quarter, it was 35% as a percentage of sales in ads. Final question before we let you go, Varun, and this is with regards to your business itself. You said that you reach out to about 120,000 stores currently. Offline will be your next leg of growth. So, there are a lot of large traditional players already in the offline space. They have a much bigger moat than you. What are the challenges of scaling this offline? Because on the one side, you can look at it as a big opportunity, but the large players are waiting for you to enter the store so that they can, probably pounce on you. So your thoughts on the challenges of scaling offline and your next hero product, because a large chunk of your revenue still comes in from onion hair shampoo and the Ubtan face wash.
So to answer the first question, I would say, Mangalam, that, finally consumer is the one who decides. Right? It does not matter what the companies might be thinking or competitors might be thinking. Right? When the rubber hits the road, when you're sitting on the shelf, right, the consumer makes the decision, right, and buys the product. Right? So I think our focus is completely on there, right, to provide high quality, innovative products that consumers love. Right? And they've been showcasing their love by picking the product from the shelf. Right? Now we just need to provide it in more shelves. So I think that's what we will continue to do. And on your other question, I think we have a fairly well diversified business. Top 10 products contribute only 30% to the company. Right? So there is a lot more that is contributing to our growth. So it's fairly diversified in that sense, and hence that risk is low. So there is a lot of newer, amazing products which have already started shaping up very well. Multani Mitti face wash, our derma company serums, our Aqualogica sunscreens are doing phenomenally well.
Varun, final question before we let you go. You've grown the business so well. Now you're going to be listing the business as well. But didn't any of these large companies come in there and say, guys, I want to buy you out. Here's the big check, and could we pick you all up? Has that ever happened?
Many times, right? But I think we're doing
So what
this
went wrong, Varun? What went wrong? The size of the check wasn't big enough?
No, it's just that we don't know what better to do. Right? I think we are in this for decades. We love what we do, and building this business and these brands just gives us so much joy. And early morning sitting in this office is just
Yeah.
the best thing that happens
Got it.
to both of us, me and Ghazal. And I don't
Okay,
think
all right.
part way
So,
that.
okay, interesting. I always wondered. So, obviously, there were people who were interested in the business, but you believed in running the business. Wish you all the best. It was good chatting with you. Mangalam and myself have enjoyed this. This is pre-IPO. On listing, we invite you back on the show. And at that point of time, we're going to push you a little bit for some numbers as well.
We always do, Varun, and you always keep, pushing the can down the road with the numbers. But this time around, the next time, we're not going to let you go. We talk about the numbers as well. But thank you for joining in.